Compared to the previous voiceover, this is going to be relatively short because all we're going to discuss here are the metrics, I call it, or the ratio analysis that we use to evaluate a company. These are probably some of the most important metrics. We have a lot of metrics, ratios that we use in accounting, but these are some of the most important that exist. Earnings per share, you've probably heard of this, and a company will report this. It is in the news, and if a company's earnings per share drops from one time period to another, it's major news. I usually like to see earnings per share constantly rising for a company, which means their earnings are going up, and the per share amount really talks about the amount of net income that you could proportion or put aside for each number of shares that is outstanding. So now you know the terminology of outstanding, so you know what it means. It means the number of shares that are held by the public. During a given time period, since earnings is going to be for a time period, the number of common shares outstanding will change. It can change because the company will issue more shares, it will declare dividends, it will have stock splits. There are a number of things that can happen to change the number of shares outstanding. So when we calculate the metric which has to do with earnings per share, on the denominator we average the number of shares that are outstanding for that time period. So if we did the income statement for the month of November, we would calculate the average number of shares that were held in the public in November, and that would be the denominator. If we did it for the year, and it was net income for the year, then it would be the average number of shares outstanding in that year in the denominator. The other thing is on the top is not just net income. We know net income is earnings, and per share means the earnings will be on the top and the shares will be on the bottom. But it's not just net income. It's net income minus preferred dividends, because earnings per share is earnings per common share. So even though it doesn't say EPCS, it's earnings per common share. So the common shareholders, it's going to be the amount of net income for each share. If you took net income and you split it up like a piece of pie, and each little piece of pie represented a share in the company, this would discuss the value of that amount, or earnings split according to the number of shares. Again, if there are preferred dividends which are declared, you're going to have to subtract it. So here we have National Beverage income of $46.92 million. They had preferred dividends of $0.15 million. And the average number of shares is 46.2 million. So you put the numbers in and find that earnings per share is a little over $1 per share. Now this in and of itself really doesn't have meaning. What you need to do again is compare this for National Beverage's earnings per share in the past periods, and you also might compare National Beverage to other companies, similar companies, and how much their earnings per share would be. Return on equity, okay? Return on equity is very similar to earnings per share, except for instead of looking at average number of shares outstanding, you're going to look at the average value of stockholders' equity. And this is the common stockholders' equity accounts. So National Beverage income was $46.9 million, preferred of $0.2 million, and average common stockholders' equity was $86 million. You put that number on the bottom. The return on equity was 54.3%. I think this is marvelous. Price earnings ratio. Now, this is an interesting metric because you have price per share and you have earnings per share. And often this is referred to as a price-earnings multiple, because the current stock price should be more than the earnings per share. So the current stock price per share should be greater than the earnings per share. So it's often referred to as a multiple. And my general rule as an investor is if I can see this value at 10 or under, then that stock is pretty cheap. If I see it getting up to 20, then I can consider that stock price to be very high, probably overpriced. So if you compare their current stock price to how much it's making per share in earnings, you can figure out whether the stock is over or underpriced. This is just a metric that companies use. So stock price is $17.92 when their earnings per share is $1. And a rough calculation will just tell you, well, that's a multiple of around 18, right? So it's a multiple of 17.7. And as I said before, my general rule is 20 is too high priced a stock, and 10 is a very cheap stock, so this is right there in the middle, getting toward the higher priced range. If you have companies, you can take the companies and you can compare these numbers then between time periods. For example, in the earnings per share for National Beverage, you can see that it improved in 2013. And for Pepsi Company, they also saw an improvement. We like to see this. It should at least hold steady. And then return on equity. Return on equity for this company, for National Beverage, I think we had these numbers. This is 43.6. This is 54.3%. This number has held steady, so return on equity held steady for Pepsi, but it is improving for National Beverage. Price earnings. Which is the higher priced stock relative to earnings? Well, the higher priced one, the multiple which is highest, is for Pepsi, and it's higher for both years.